We have all made mistakes with our money at some point, but it's especially easy to make these mistakes when you are fresh out of school and trying to figure out life as a 20-something. These are 7 money mistakes that you want to avoid making in your 20s. Welcome back to the channel. If you're new, hi, hello, welcome. I'm Suzanne with Arvabelle, and if you're not already subscribed to the channel, consider subscribing for more videos on money and mindful living, and don't forget to hit that like button. So mistake number 7, which is actually one of the most common ones, is expensive cars. A lot of times, especially in our 20s, we see people around us, like coworkers or our friends, buying new luxury vehicles. But before you go and buy one for yourself, you want to consider all of the costs associated with buying a new vehicle. There's maintenance, there's car insurance, and there's just the payment on the car itself. New cars are a severely depreciating asset, which just means that when you drive that new car off of the lot, it's worth a whole lot less. Even if you were to immediately turn back around and go back to the dealership, they would not buy that car back from you at the price that you just bought it for. Either drive the car you already have if you do need a new vehicle, buy it used, or if you are lucky enough to live in one of the few places in the US that has good, reliable public transportation, just use that instead. Don't make the mistake of letting a luxury car you can't afford drain your bank account. Mistake number 6 is no money down financing offers. Now these are very, very tempting, and they're pretty much everywhere. You see these in mattress stores, furniture stores, even around Christmas time, department stores have financing options, and usually these are not a good deal at all, and they will actually end up hurting you in the long run. So with these offers, they will make you some too good to be true deal, which it is. They'll say you put no money down and you make a small payment of $60 a month for the next eternity. And in these offers, in the fine print, they put a bunch of confusing clauses that basically allow them to raise the interest rate on that payment that you're making. And many times that rate actually ends up being higher than interest that you would pay on your credit card, which you shouldn't do that either, but it's a pretty bad deal. And that is why these companies push those financing options so hard, is because that is how they are able to make a lot of their money off of interest that people really aren't able to keep up with. These no money down financing offers are a very, very easy way to get sucked into very high amounts of consumer debt. So if you can't afford it up front, just don't buy it. You can save up for it. It may take you a few months or a few years, but you really don't need that instant gratification of new furniture if you cannot afford it. Mistake 5 is signing up for way too many subscription services. So I get it, subscriptions are nice, they're convenient, they're supposed to make our lives easier. And the amounts don't really seem like that much for monthly subscriptions, but those small amounts add up and they will leave you wondering why you have no money left at the end of the month. So between all of your streaming services, all of your subscription boxes, and all of your memberships too, like to gyms or places like that, take a good look at that and start evaluating where you can maybe consolidate subscriptions and combine them, or where you can just cut them out completely. Number 4 is taking on excessive student loan debt. So if you're already out of college, there isn't really much that you can do. You're just gonna have to pay it back. But when you're paying it back, make sure that you are meeting those monthly payments and always contribute a little bit extra if you can. So the faster that you can get that paid off, the quicker you're going to be reducing that interest amount that you have left to pay. If you are still in college, if you can start making payments on your loan before you graduate, that's always a good thing to do. But if you don't really have that option, just be proactive in reducing costs. Take basic courses at community college, rent textbooks off of Amazon because you probably won't need them, and don't blow your bank account going out every night. If you think you want to continue your education and do grad school, make sure that you're doing it for the right reasons. If you're enrolling simply because you don't really know what else to do, take some time to consider if that is in your best long-term financial interest. And sometimes it will be, and that's great. Just make sure that you are going and paying that tuition for the right reason. And if you're not in college yet and you're on the fence about it, there are plenty of high-paying jobs that don't necessarily require a college degree. College is definitely worth it for a lot of people, but it's not the only option out there. And there are ways to get a higher education that don't require you going into tens of thousands of dollars of student debt. Mistake number 3 is is not caring about your credit. I have a whole separate video on this, which I will link up in the cards, but basically if you ever want to buy a house, a car, take out any type of loan, or even sign a lease at a nice apartment complex, you're going to need a good credit score, and it takes a little while to actually build that up. It's easier to build up a good credit score from the very beginning than to try and fix a bad credit score. So the general gist of credit scores and using credit cards is pay your amount on time and in full every single month. Credit cards are not just magic money. That is money that you owe, so don't buy anything on a credit card that you can't actually afford. Mistake number 2 is leaving money in cash or in a low yield savings account. This is the easiest one to fix. And if you take nothing else from this video, go and open up a high yield savings account. It's so easy. It takes like 5 minutes to do. So basically, if you are just letting your extra money or your emergency savings sit in cash or sit in a low yield savings account that's earning you 0.01% interest, it's time to open up a new bank account and to transfer that money into there. Interest rates are getting a little bit more competitive, and I know that there are some companies that have cut back a little bit recently, but I would say that around 2% interest is a pretty standard rate. It may not seem like that much, but say you have $5,000 in an emergency savings account, that can be earning you at 2% interest $100 a year, and you don't even have to do anything for that except for set up the bank account. When you sign up for a high yield savings account, just make sure that it's with a reputable bank that is FDIC insured. Make sure that you read everything and all the terms, especially because at some banks, to get a better interest rate, you will have to have a large amount of money in there. But I know that there are plenty of options available that don't require any minimum balance to earn that 2% interest. So mistake number 1, the biggest mistake of them all, is not investing when you are in your 20s. If you are not investing now, you could be missing out on thousands or hundreds of thousands of dollars in compounding interest. So how can you start investing? See if your employer offers 401k matching. Sign up for a Roth IRA. Research stocks that you'd be interested in buying. Learn about real estate. Look into getting a financial advisor or a robo-advisor. But most importantly, just educate yourself about investing. There are hundreds and hundreds of articles and books and videos on this channel and just all over the internet that can teach you how to invest. By no means do you have to be an expert, but it is important to start learning about investment opportunities and taking advantage of things that you see value in and saving for your future. I hope this video was helpful. Remember to subscribe to the channel and check out our videos on credit score and investing. I hope you guys have a good day, and I will see you next time.